Hi, everybody. Welcome to Stop Being Sold, a community of informed consumers who are sick and tired of being sold financial products they don't understand or need. So if you're tired of being a transaction, go ahead and hit that subscribe button and also the notification bell so you never miss another video from us. How are you today, Brian?
Hey, Michelle, I'm doing great. How about yourself?
I'm doing good. Thank you so much. So our topic today, we're going to take a deep dive into the different types of IRAs and what really, whether you hold one now or not, this is important that you know that most people know the traditional and they know the Roth, right?
Yep.
But there are 4 other types for a total of 6, 2 of those being for small business and then 4 for individuals. So, you know, like I said, even if you hold a Roth right now, it's really important that you understand that there are different types out there and one may fit you better than another.
And you're right, Michelle. It's all about how they fit you as an individual. And
right.
So they were each designed for different purposes. So
Exactly.
let's define some of them today.
So what we always talk about, what do you need? What are you looking for? What are your goals? And then find the financial product that fits that rather than picking a traditional because that's what your brother, sister, mother's dog has.
Yeah, that's true. And make sure you know what you have. So
exactly. All right. Well, without further ado, let's dive in. So the traditional, let's start there.
Okay. Michelle, this one here allows you to save money on a pre-tax basis. Mm-hmm. Pretty simple. This is probably the most popular one out there that we see because of the longevity of it. Sure. Your contributions get to grow tax deferred. So let's say every year you go and get your taxes done, your CPA says, oh, you know, to save some money this year, put X amount of dollars into your IRA. This is the IRA they're talking about. So you get that tax break up front. Right. So you get that tax deduction immediately up to your income limits. Your contributions for 2021 and also for 2022 is $6,000 that you're allowed to put in unless you're over the age of 50. Then you're allowed that $1,000 extra for a total of $7,000 for catch-up contributions.
And really quick, Brian, for when you mentioned 2021, people have until tax date, which is April 18th, 2022 for most states this year to fully fund an IRA for 2021.
Yes, that's the last date that you're allowed to do that. So either the day that you file your taxes or up to the last date, which is April 18th this year. So,
okay.
And Michelle, and this one also, anyone with income, earned income can contribute to this plan, okay? Withdrawals, I always get that question. Okay, so if I put my money into this, when can I take my money out? Well, once you put it into this, your withdrawals are penalty free after age 59 and a half. If you take out before that, Michelle, you got 10% penalty from IRS taking it out before 59 and a half. And currently, as of right now, today's law is your RMDs, which is your required minimum distributions. You must start taking these at the age of 72. And you will be taxed anytime you take out withdrawals, Michelle, you will be taxed as normal income in the year that them distributions are withdrawn.
Okay. All right. So that's the traditional. How does the Roth differ?
Roth is my favorite, just saying. Okay, so this is the one, Michelle, that allows you after tax contributions. So after you brought home your paycheck. So you don't get a tax break for putting into it up front, okay? But the beauty of this, it gets to sit there and grow tax-free as long as you follow the main guidelines. You don't get that tax break in the year that you deposit the funds in. Your contribution limits are the same as a traditional IRA that we just mentioned, $6,000 in 2021 and 2022, $7,000 if you're over the age of 50. But you can contribute if your earned income stays below $140,000 for a single person and married filing joint below $2,000 or $208,000 for the year.
Okay.
And the sweet spot that we've talked about many times is, Michelle, the withdrawals from this plan are penalty-free and tax-free after 5 years and after the age of 59 and a half. That's it. That's the beauty of it. So,
got it. All right. So we did a video called Roth IRA Explained. It's a deep dive into the Roth. We'll put the link below in the video here or in the description. Highly suggest you check it out.
Yes.
And also we did a deep dive into the differences. I mean, you named them here, but it's a bit more, we go deeper into the difference between a traditional and a Roth. So that is also worth checking out. All right, so let's move on. So we've got traditional, we've got Roth, and now we have the spousal IRA.
Most people don't know about this one, Michelle.
Right.
They hear about it, maybe an article they read or something like that. So we did a great video on this one too, and a blog post on this one. So we'll put them links down below. But Michelle, this allows a stay-at-home husband or wife, and think about the environment we're in today, where because of the pandemic, one of the spouses was staying home a lot more often. And I think we're going to see that over the long term, right? This allows a stay-at-home husband or wife to open a retirement account in their own name as long as one person had household income, earned income, okay? And you file a joint tax return. So you can open and contribute to this account.
2 stipulations: you have to file a joint tax return.
Yes.
And you have one member of the household, one of you has to have earned income. Earned income.
And so, Michelle, what this allows is it takes the non-working spouse and allows you to contribute as much to the spousal Roth IRA as the working spouse. This is huge.
It is.
So
it helps later on.
Yeah. Well, then think of it this way. You're talking in 2021, the annual contributions again were $6,000 for Roth and traditional. You get that same amount plus the additional 1,000 if you're over the age of 50. So it's pretty exciting.
So let me just get this straight. If there's spouse 1 and spouse 2, right?
Mm-hmm.
Spouse 1 can put in 6,000, up to 6,000 if they're under the age of 50.
Yep.
And spouse 2 could also. It's not 6,000 total for both. It's
no,
because it's
6,000 each.
About the non-working spouse's name.
Yeah.
Okay.
And if one's above the age of 50, that person can put in an extra 1,000.
Sure.
So, I mean, and here's the key. The amount of the combined contributions, Michelle, cannot be more than the taxable compensation that you put on your joint tax return.
Okay.
So, so what that says is if you're both over the age of 50, that allows you to put 7,000 each in, right? Mm-hmm. Okay. You're allowed to go up to $14,000. But if you only make 13,000 for the year, you can only put 13,000 in.
Makes sense. Okay. Perfect. And like Brian said, we'll put the video, the link to that video that we just did on spousal IRAs below as well.
Yes.
So let's move on. The self-directed IRA. This is big right now. A lot of people are talking about self-directed IRAs and even self-directed 401ks, but let's break this down and explain how it's different.
It's basically, Michelle, it is what it says it is. Take the name, self-directed IRA. So take the traditional IRA and now add self-directed to it. That means you are doing everything. Just remember that. Self-directed.
And can it be a Roth or a traditional?
Yes, it can be either one. And the beauty of this is this allows you as an individual to look, as an advisor, I set up Roth IRAs and traditional IRAs every day. Okay. That's normal. Okay. But this allows you, Michelle, to invest into assets outside the normal that you deal with your advisor. This allows you to go into like real estate, crypto, gold, commodities, tax liens, limited partnerships. It's kind of like it's unlimited as far as what you can put in. There's a couple stipulations that the IRS don't allow you to go into, but honestly, you're in control of this. You'll see advertisements on this all the time on TV, the gold IRA, and now you're hearing crypto IRAs. You're hearing that all the time. You got the same limits as a traditional IRA, 6,000 or 7,000 if you're over the age of 50. But here's the difference, Michelle. Here's where you have to be careful. Custodians. So wherever you're holding this at, maybe it's a trust company, maybe it's XYZ brokerage or whatever it may be, they will not give you investment advice. They're not allowed to. That's where the word self-directed comes into it. You, as the individual, have to do it all. It's that simple.
Okay. What else do we need to know about self-directed IRAs?
Yeah, well, here's one more thing you got to think about in this. If the assets or the transactions that you do inside that account end up being prohibited, IRS can force you to liquidate that account immediately.
Interesting. So,
and when that happens, it is now a distribution. And if you're under the age of 59 and a half, that is now fully taxable with a 10% penalty on top of that.
If all of a sudden, let's just say they prohibit real estate, let's just use this as an example, real estate holding real estate within this IRA, you can't quickly roll it over to another IRA, roll your funds over. It's the count is distributed, like they cash you out. Is that correct?
Yeah, let's explain that a little bit further, because here's the scenario. If you were allowed to go into real estate today and IRS changes the rule tomorrow, you were grandfathered in with what you've already had in the account.
Okay, got it.
But let's say you didn't read the rules and you weren't allowed to do this transaction inside of there, but you did that transaction. Now that's considered a distribution and IRS will force it. So
understood. Okay.
Yeah. So you're kind of like grandfathered in with the stuff that you can do in there today. But there's some artwork that's not allowed in there today and stuff like that.
I don't think collectibles.
Yeah, no collectibles either. Yeah, you're right. So, but again, because it's self-directed, you could end up having higher fees depending on the custodian and the assets that are held in there over a traditional IRA or Roth IRA. And Michelle, they could be less liquid because some of the stuff in there that you place inside there, like real estate, for example. Yes. In today's market, real estate, look, there ain't enough houses. But in 2008, 2009, no one wanted your house. So it could be less liquid in the future, but there are some benefits to definitely having the self-directed IRAs.
Oh, for sure. For sure. Okay. So those are the 4 that are for individuals. Let's talk IRAs for small business.
Okay, primarily 2 main ones that we see out there all the time now, the SEP IRA and the Simple IRA. Let's start with the SEP IRA first. It stands for Simplified Employee Pension Plan. It's a pretty simple program. It allows an employer to set traditional IRAs for themselves and the employees, okay? There's no limit on the size of the business. That includes you could be a sole proprietor and just be self-employed. You can set up your own SEP IRA here. So the difference between this and like a big 401k plan, Michelle, is that you don't have the startup and ongoing cost of a traditional workplace retirement plan like the 401k.
401k, right? Okay.
Right. So, but this plan only allows employer contributions. Employees cannot contribute to this plan.
Okay.
And then the employer contributions must be equal to all eligible employees. Okay. So if I'm putting in for you, Michelle, and Johnny over here and Bob over here, and I put in $1,000 for myself, I got to put $1,000 in for every one of them. Does that make sense?
But if you're a solo proprietor, if you're solo, you just put it in for yourself.
You're exactly right.
Okay.
And there are some maximum limits to eligibility, like you must be 21, you must have worked for an employer for 3 of the last 5 years, and at least $650 in compensation per year. But I said they're max limits.
Okay.
The beauty of this, Michelle, is as the employer, that's the maximum limits, you could have no limits at all and give everyone the same opportunity to start to plan immediately. And that's the max that you could do. You could just get rid of the requirements. So
what are the contribution limits like with the SEP?
Okay, so it's based on the first $305,000 of compensation for 2022, and your annual limits are the smaller of $61,000 or 25% of your income. So if you make $100,000, let's say you're self-employed, your income's $100,000. You can't put in $61,000. It's the smaller of $61,000 or 25% of your income. So you could put in $25,000.
Okay.
And the employer, Michelle, gets to deduct the contributions and gets a tax break because the funds go in tax, pre-tax money, right?
Right.
But the employer and the employees are 100% vested immediately.
Got it. So
Unlike some 401ks, you have to be vested over a 5-year period. So
Sure. Okay. Interesting. All right. So is there anything else we need to know about the SEP before we move on to the simple?
No, that's basically it. Contributions can be flexible. Okay. So there's one more thing. Think about this. Let's say it's a great year. You're having a great year and you want to put more money in, you can. And let's say next year it's a horrible year and you don't have extra funds. It's flexible.
Right.
So you can put less in.
That's a big benefit right there.
That's a big question I get asked all the time, Michelle, is if I set up this workplace retirement account, am I mandated to put the same amount in? And see, this would be a plan that is flexible for the employer.
Great. All right, let's move on to the simple IRA.
Okay, the simple, almost the same guidelines almost, but it stands for Savings Incentive Match Plan for Employees. Okay. This plan, Michelle, unlike the SEP IRA, allows you as the employee to also contribute. So employers and employees can contribute.
Okay.
Right. This is designed for smaller businesses. You'll see this like under 100 employees. I remember over the years, like a little small dairy would set one up that had 30 employees, and they would match what the employees put in and stuff. So, but the employer, there's some requirements for the employer here though. You're required, you have to contribute to this plan. Matching contributions of up to 3% or 2% of non-elective contributions. That means employees that don't contribute, they still can get that 2%.
Oh, interesting.
Okay. And it's not flexible like the SEP IRA. There are set percentages like we just discussed.
Got it.
Employee, again, though, is vested 100% at any time. Easy to set up, same as the SEP. But here, you're required one of the two, matching contributions up to 3% or 2% of, so basically 2% across the board. So.
Okay, got it. So real quick question before we wrap up. So I have a Roth. Let's use me as an example. I have a Roth IRA. And I also own my own business. And right now I'm a solo entrepreneur. I'm right. That's what,
yes.
Sole proprietor. I might want to look into possibly a SEP IRA.
Sure.
Because I mean, obviously I have to bring in the income, but it's flexible contributions and I can put in a lot more than just the traditional 6,000.
You sure can.
That's
and get the tax break.
And get the tax break for it. Okay.
You're exactly right. So it's nice to have both.
Right.
And as an employer or self-employed individual, you can do this and really funnel money into your retirement program.
Right. Awesome. Okay, great. Thank you so much. All right. Anything else we need to know about the types of IRAs?
This basically, it goes back to what we said in the beginning. There's 6 different ones here, 4 with individuals and 2 with businesses. Every circumstance is different.
Right.
This is why you truly need to work with advisors that understand the whole process, that aren't there just to sell you a product. They truly need to understand what you are trying to accomplish, what you want your retirement to look like, how much you want to contribute, if you can contribute every year. There's a lot of factors in here, and we've talked about the differences today. And now many of you probably don't understand that, oh my gosh, I didn't know all these options were available. Now I do need advice. So.
Okay. All right. Well, thank you so much. And if you like the content of this video, go ahead and hit that like button. We'd appreciate it. Helps us grow the channel and lets us know that you like the content we're producing. If you have questions, please leave them in the comments below. We do answer those, and we've often made videos on some of the questions we've received or incorporated those questions into our videos. Thanks, Brian, for everything, and thanks everybody for watching to the end.
Thanks, everyone. Have a great day.